What if a high cost of living is only half the problem? We've spent the last few years treating inflation as the single greatest threat to the American economy. That a new set of data suggests the ice is cracking somewhere else entirely. This line chart tracks the recent downward trajectory of inflation. In July 2026, U.S. consumer prices increased 3.4% over the previous year, with the monthly rate ticking up just 0.1%. On the surface, the central bank's strategy appears to be working. But as this shifts to a cumulative area chart, you see the actual burden on American households. Prices are not falling. They are simply rising at a slower pace. The total cost of living continues to stack up, month after month. Energy costs are heavily driving this ongoing pressure. Over the past year, overall energy prices jumped nearly 15%, while the cost of gasoline spiked by almost 25%. Lower inflation readings offer zero actual relief at the cash register. They merely lock in a permanently higher baseline cost of living that steadily consumes household budgets. While everyone was focused on checkout receipts, a completely different pillar of the economy started to give way. The labor market suddenly lost its footing. This bar chart tracks monthly job growth, which had been steady for months. Then, in July, it snaps into negative territory. The economy unexpectedly lost 23,000 jobs in a single month. And as the highlight moves back across the previous months, notice how earlier job gains are quietly revised downward. The perceived strength of the labor market was masking a longer-term decay. A shrinking workforce colliding with stubbornly high prices ruins any expectation of a painless economic recovery. Policymakers are now walking directly into a trap. The Federal Reserve currently holds its federal funds target range between 3.50% and 3.75%. That rate is the primary lever they use to steer the entire U.S. economy. But interest rates are a blunt instrument. They affect everything at once. The Fed cannot isolate and treat one specific sector without sending shockwaves through all the others. To kill that remaining 3.4% inflation, the Fed needs to keep rates high. But expensive borrowing actively chokes off business expansion and forces companies to lay off workers. To rescue the bleeding labor market, they need to cut rates and make money cheaper. But injecting cheap credit into the system would send consumer prices surging right back up. The central bank cannot deploy its primary tool to fix one side of this crisis without intentionally inflicting massive damage on the other. This balance scale illustrates the state of economic limbo the Fed is currently trapped in. On one side, 3.4% inflation. On the other, 23,000 lost jobs. The economy violently tips between these two threats. But if inflation stays above 3% while hiring plummets, the scale breaks. This is the exact nightmare scenario policymakers are desperate to avoid. The officials steering the Federal Reserve have run out of easy mathematical choices. Every upcoming decision requires accepting severe collateral damage. Acting too soon to save jobs guarantees runaway prices. Waiting too long to control inflation guarantees a severe labor collapse. The greatest risk right now is policy paralysis. That macroeconomic uncertainty transmits instantly onto the trading floor. When the Fed hesitates, Wall Street experiences extreme volatility. This chart compares two diverging trend lines for technology stocks under two different policy paths. These massive tech valuations depend entirely on future earnings, which are tied directly to expected interest rates. Notice how the rate hike projection line gets crossed out after that weak jobs report. Traders rapidly pulled back their expectations for a September rate increase, causing the remaining rate cut line to become highly erratic. The volatility of a cornered Federal Reserve is now being priced directly into the market, a factor that carries more weight than simple reactions to raw corporate data. But you don't need a portfolio of tech stocks to feel this collision. The Fed's dilemma dictates everyday financial decisions. Shifting interest rates immediately dictate the housing market. It changes the reality of securing a mortgage and determines if a family can move. That single central bank policy ripples out to dictate your credit card APR, the cost of an auto loan, and your basic savings account yield. So look past the daily headlines. The true health of the economy will be revealed in the next few consumer spending reports, job recovery numbers, energy price fluctuations, and the specific language the Fed uses in its next meeting. The conflict between stabilizing prices and saving jobs is entering a new, more dangerous phase, leaving the American consumer to navigate the resulting fallout.